In this video, I'm going to show you guys how you can retire and generate safe passive income of up to $20,000 a month consistently every single month, and possibly even quit working and retire early. Don't worry about looking for the subscribe button, liking this video, or the link to the Discord and coaching to sign up. We will talk about that in just a little bit. Let's get right into this video so I can show you guys how you can generate consistent passive income and retire early. Before we dive into today's video, huge announcement. I am hosting my free webinar this Sunday, November 10th, 5 p.m. Eastern Time, 2 p.m. Pacific Time. You will learn more in the 1 hour you spend with me than you will anywhere else. That's what every single student that has attended the webinars has said in the past. I will have a huge announcement during this webinar. You won't want to miss it. And I'll be hosting a Q&A where you can hang out with me and I will answer your questions. I have a lot to teach. It's absolutely free. And you guys can use the link in the information box below to sign up. I hope to see you guys there this Sunday, November 10th, 5 p.m. Eastern, 2 p.m. Pacific. I'm going to show you guys a strategy on how you can set up your portfolio. If you have a $50,000 to $100,000 portfolio, you should be able to generate around $3,000 to $7,000 a month. If you have a $100,000 portfolio, you can get pretty close to $10,000 a month quite easily. If you have a $200,000 portfolio, you can make between $10,000 and $15,000 a month quite easily, and you can make $20,000 a month or more. Of course, if you have more than $200,000, you're pretty much consistently and safely making $20K a month plus. So let me show you guys exactly how to get started. There's two strategies that I pretty much use in my portfolio that are consistent and safe, and selling cash secured puts are one of them, but another way is buying LEAP options and selling covered calls against it. However, when you buy LEAP options, which is long-term in the money call options that are 6 months or further out in expiration, and you're selling covered calls against them, you want to make sure that it's on stocks that have less likelihood or a lower chance of pulling back and are more consistently consolidating and appreciating, going up in value. So stocks that go up a bit, consolidate, go up a bit, consolidate, maybe a little pullback, consolidate, and go up a bit. This way, they're not stocks that are going to just dip and be very volatile like Tesla. I'm not saying Tesla's not a good stock or that you can't run this strategy on it, but we need to find a candidate that spends most of its time going up, consolidating, going up and consolidating. This way, we're not losing value, if any, and if we are, not very much, on the LEAP options. And the best way to do this is on ETFs like QQQ, TQQQ, IWM, SPY. These are awesome. There's also TSLL. There's other high leveraged ETFs for stocks or leveraged positions, but I highly recommend SPY. SPY is the best that has zero DTE and daily options, or you can go every other day or weekly or even monthly, but I prefer to go daily. But just understand, if you have less than $25,000 in your portfolio, you cannot sell zero DTE on deep in the money LEAP option. And the reason you can't do this is because most brokerages, not all, but most brokerages won't allow you to have a short position on shares. Since it's a LEAP option, you don't actually own the shares, but you can, of course, use the LEAP option to exercise to cover the share assignment on your short call if this was to happen. So you sell a short call or a covered call against the LEAP. If that gets assigned, you exercise the LEAP to cover the position. Worst case scenario. That really is a worst case scenario. However, most brokerages will not allow you to have a short position near the end of the day. So at 3 p.m., they're going to close out your short position. So even if it's only worth $1, they're going to close it for $1. So you're not losing any money. You make, let's say, $100 and you buy it back at $1. You're not really worried about that dollar, but where the problem is, that counts as a day trade. You sold it in the morning. They force you to buy it back instead of expiring worthless, which would not count as a day trade. So if you sell it in the morning, they close it in the evening for $1. You do this 3 times. You're now a pattern day trader because you can't have more than 4 day trades in a 5-day window. So this is not a good thing. If you have more than $25,000, then you can do this, but it's still not good, because once you become a pattern day trader, the only thing that $25,000 or more in account value allows you to do is to continue to day trade and to continue to invest and trade like normal. Well, that's a good thing, right? That's really, truly an awesome thing. But there's a problem. Once you're a pattern day trader, that brokerage account is no longer eligible for cash sweep on the APY, so you no longer get interest on your uninvested cash, and you can no longer use margin or have stock lending. So you lose all of your features that you'd want in an account. No stock lending, no cash sweep. So to me, it's not worth it. So I'm not really doing pattern day trading at all. I just do it every other day on the SPY. I have students that have used this strategy to generate 50%, even 75% returns in as little as 2 to 3 months. I have students that have taken $8,000 portfolios to $25,000 in 3 months. Other students have went from 300K to almost 500K in as little as 4 months. So this strategy works. My students are using it. I am using it, and we are making consistent, safe, and passive income. And I have many students that have actually retired after joining my Discord. If you guys are interested in growing your portfolio and achieving financial freedom and retiring early, I would love to help you guys out. You could sign up for my full Discord training course and one-on-one coaching at any time at investvithcorey.com. The link is in the information box below. It truly is what drives me every day, is to help others. I grew up in a Catholic household, and my parents were very hard on me for always doing the right thing and helping others whenever I had the opportunity to do so. And in 2020, when I achieved financial freedom, I told myself I was going to find a way to grow my portfolio, learn the stock market better, and in time, I created a system that works to help others achieve the same success, which truly makes me happy. When my students are successful, it makes me happy. So if you guys would like to take control of your financial freedom, I would love to help you. And ultimately, if you show up committed and ready to learn, I show up committed and ready to show you exactly how to grow your portfolio. And I look forward to speaking with you when you are ready. But let's take a listen to what my student Adam had to say.
In just a short amount of time, the program that you offer, I've learned so much, and I've changed my entire approach to investing. You know, I'm much more structured, much more safe, and I've seen consistent, profitable growth. I've seen the growth. And it's almost like unbelievable. Like in a market that we're in now, I was still able to consistently grow because you're so, methodical and structured, and you care about each student. I'm here to say it how it is, right? I've made consistent growth. So I started with 15,000, right? I am now at $40,000. Okay. And I'm so proud. It feels, amazing to be able to share this, because I know that there's so many people that will do the same, right? You have to just trust Corey and trust what he's teaching and what he's offering, because he means so well.
So we are looking at the SPY. Now, I told you guys in previous videos that the SPY was going to go up after the elections, and so would the stock market, and that's exactly what happened. But that aside, if you guys are wondering, how do we set this up? How do we set up making consistent, safe, passive income on the S&P, other ETFs? Well, there's a certain diversification that has to happen here. What we have to do is we have to run certain percentages of our portfolio in order to be safe. And if you only have $100,000 or say $50,000 or $100,000 account, you really can't sell cash secured puts, because you can only sell 2 of them, and that would put your position at being 50 or 100% in one stock. Now, the S&P 500 is an ETF with many stocks and covering many sectors, so it's not as big of a deal. However, I wouldn't recommend selling cash secured puts on the S&P 500 unless you had $250,000 or more. If you have a $250,000 account or $500,000 account, you can sell 1 or 2 or 3 puts a day, and it's okay. I don't really recommend it, because I really don't like, even with it being S&P and it being an ETF, I don't recommend having more than 25 to 35% of your portfolio in it. Like, I just can't recommend that. So on a smaller account, $50,000 or $100,000 account, the best way to do it is to run poor man's covered call, LEAP options, because you can run 4 to 5 of those LEAPs, and it's only going to cost you about $3,000 to $4,000 per LEAP. So on a $100,000 account, you're only running about 20 to 25K, which is 20 to 25%, which is fairly safe in my really far extreme of safe on the S&P 500 for the green area. I personally like to keep it at 20 to 25%, so that's what I'd recommend. If you have a $200,000 account, then you could easily run $25,000 to $35,000, and you would be between 12 and 20%. No problem. That is good. So I'm going to show you guys exactly how to do that, but we're also going to diversify. We're going to run a few credit spreads on top of that on maybe Tesla and the S&P 500, but this is how you consistently make safe and passive retirement income. So what we want to do, we want to get the LEAP options for as cheap as possible, but we don't want to time the bottom too hard, because even if we buy these LEAP options and the stock or the ETF comes down, we're going to be able to dollar cost average. You're going to be able to sell covered calls. So this is what we're looking for. The SPY jumped. We got a very big gap. The bottom of the gap is 583. Elections are over. PMI services data came out. It's good. Inflation data is good. Chances of the SPY going below 583 by the end of the year, very low, considering November, December, and January are strong months. PMI data is good. Inflation is good. Elections and uncertainties have passed. A strong candidate has taken the White House. That's not my opinion, but based on the actual facts, financially from the previous term, 2016 to 2020, was very good. So looking at this, it is, in my opinion, that the chances of the SPY falling below 580 is fairly on the low side of things. So right now we can see that it dropped and we have a higher high and a lower low. So right now, timing to get in the next week or so around 588 is probably all we're going to get. But I would not buy all of my LEAP options at once. I would buy two now. If the stock or ETF goes up, buy another one or another two. And then if it drops, buy one or two more to bring the cost down, just like you would with shares. Dollar cost averaging, whether it's going up or down, you're adding to your position and selling covered calls. I actually just did this with the S&P 500. Right here, I'll show you. I purchased one for $39.20, one for $44.85, and one for $4,500. This gave me an average cost of like $4,300, and I sold all three this morning for $49.50. So I made almost $2,000, like $1,900. I made like $1,900 profit, sold them today, 17 hours ago, and I bought them on the 31st. So I made $1,700 in a week, and that doesn't include the short calls. So I made $1,700 plus the short calls, which was 76 and 118. Let's add this up. 118 plus 76 plus 45. It's 239 plus a 70 right here. 309. So I made 309 plus 14,850. 14,850 minus 3920 minus 4485 and minus 4500. I made $2,254 in a week, and this was on $13,000. So this is basically a 20% return in a week. Now, granted, that's pretty insane. Usually it's more like 5% per week or 10% per week, but this just shows you that I made $2,254 total profit on just a little over $12,000. That means at this rate in a month, that would be $8,000, which is a lot. That's 80% per month. That's really kind of due to the elections. I bought on the bottom, which is right around here. I first purchased right here and then purchased more down here, and then it ran. So this is really good timing by my part. So I should have held on to these positions, but I'm looking to get back in and do it again. So I'm going to show you guys what I'm looking to do is once the ETF drops back down somewhere in the 586, 587, maybe it will, maybe it won't, but I'm looking for that. I'm going to buy a LEAP option. I'm going to show you guys exactly how to run this strategy. First, you want to buy a LEAP option. I highly recommend going out to April 17th, and you want to look for a deep in the money option. We want to go for something that is at least $10 to $20 or more in the money. So you could look at a 560, which will run you $5,000. It's got a delta of 76, which means every time the stock moves a dollar or the ETF, you'll go up 76 cents on the option. So with you having this option, it'll go up $100 or $76 every time the stock goes up $100. So the stock goes up $1, 100 shares, $100. This option, $76 because the delta is 76. Now, you also want to look at open interest, which is 2,320, volume 244. If we look at 550, open interest goes up, but the volume is actually a little bit less. 540 is even less volume. 570 has even less volume. So right now it's looking like the 560 is the best choice. A lot of interest at 580 and a lot of volume and open interest at 590, but this delta is 60. It's a little bit on the low side. You could do it, but what happens is when you buy an option, let's say at 590, if you want to sell a covered call, let's say the ETF goes to 580, you can still sell a covered call at 585, but you have to put up $500 cash collateral collateral because you're $500 below your long option, which is why I recommend going deeper in the money. Plus, it also moves more in tandem with the stock. So if the stock goes up $1, on this one, you're only going to be looking at 60 cents, which is not good. It won't grow as fast. So it's a lot more valuable to have a deeper in the money option. 550's got some decent open interest and volume. 540 is decent, but not as good. 535 is not good. 530 is decent. 520 is not good. So far, 560 is the best one. Yeah, so 560 is the best one right now. And at a 76 delta, it's pretty good. So you're going to spend about $5,100. If you get a nice pullback in the morning, you'll get it for about $5,100. And it's like stock. If you buy two at 51 and you buy two at 49, you have an average cost of $5,050. It's the same as shares. So buy two now, wait to see if the ETF goes up a bit, add one more. If it drops a lot, then you can add one or two more to bring the cost down. Just like shares, I recommend selling out to the following day. Anyway, this way, every other day you're rolling out to the next day. Monday to Wednesday, Wednesday to Friday, Friday to Monday. And you're doing this like consistently. But first, let's buy this LEAP option. So we're going to buy your 560. And let's say we buy two. We get a little bit of a pullback in the morning, so we want to get filled right around 51. So $10,200 gives us control of 200 shares of the S&P 500, whereas 200 shares of S&P would be $100,000. We're getting this for $10,000. So if you have a $100,000 account, I recommend buying two up front, wait for the stock to go up or down. If it goes down, buy one. If it goes down again, buy one. If it goes up, buy one. If it goes up, buy one. Same thing. So whether it goes up or down, buy one. But if it goes up and you've bought an additional contract and it drops, buy two. You want to eventually, with a $100,000 account, you want to have 4 or 5 of them. With a $200,000 account, you want to have 6 to 8. So let's look at a $200,000 account. You're going to start off with 4. It goes up a bit. Then you buy one more. Then it drops. You buy 2 more. And then you're looking at having around 7 or 8 at this point. So let's say your average cost is 8 of these contracts at say $4,900, but you have 8 contracts. It's costing you pretty close to $40,000, which is 20% on a $200,000 portfolio. This is great. So let me show you guys how you can generate a lot of consistent income. I probably on a $200,000 account would go with 10 because this really is only 25% of your portfolio. And on the S&P 500, it's fairly safe. So now that we've got these contracts, you've purchased them, we are going to sell covered calls on the SPY. And we're going to go out every other day. So the 8th would be one day from now being Thursday. So we'll go out one day. And you want to find a spot to sell these covered calls. Now, when you're selling calls on anything, not just the S&P, anything in the stock market, any stock, doesn't matter. You want to go by delta. You don't want to go by strike price, because I could sit here and tell you right now that selling $592 is going to give you $100 premium. But in a year from now, it might give you $300 premium because the S&P might be $650. So we don't want to go by strike price. We want to go by delta. Typically, I like to sell 15 to 20 deltas on the S&P. When I feel like we've hit a plateau or a ceiling or resistance and we're kind of consolidating, I will sell 25, sometimes even 30 deltas, but 15 to 20 is very safe, and 25 a little bit more aggressive, but still safe enough. So we're going to look at this and see that the previous high, it's already been broken. So now we don't have much to go off of. We're going to go on the 4-hour chart, and we're going to see when the last time the S&P was this high, and it wasn't. So we're hitting all-time records right now. So it's really hard to know where the top is. What we will do in this situation is we will look at the Bollinger Band. And in the Bollinger Band, you're going to want to check your settings, make sure it's 20 length, standard deviation of 2. The more volatility, the higher your deviation. Standard deviation of 2 gives you 96.1% accuracy or probability. Standard deviation of 3 is like 99.1. So we're going to go with standard deviation of 2, and we're going to go on the 4-hour to the daily chart. And they call it a band for a reason. If you notice, every time the stock comes up, comes down, goes up, comes down, comes up, bounces down, comes up, bounces down, goes down, bounces up. It stays within the area of the average. of this Bollinger Band. If we look over here, every time it hits, bounces down, bounces here, goes back up, comes down, stretches, and bounces right back up. It'll break through, and it will stretch the Bollinger Band, but it comes back, and right now it's stretching, which means we could see this number. It could kind of come up a little bit more, come down, up, and then it's going to snap back down. The average is somewhere in here. So as we go forward, even in the next month, the average is around 589, 588. So it's likely to come back, so you'll get a chance to add more. With this being said, and with the Bollinger Band going forward, 590 is the top. So going out only one day, 595 is pretty safe. I bet you that's a 20 delta or lower, pretty close to it. So 595, it's a 28 delta. It was off by 3 points. So you'll want to sell a 597, which is an 18 delta, okay? Maybe a 598. Now, first let's discuss what happens if you get assigned. Well, you can't get assigned until after 4 p.m., which of course you're selling this short call out to the next day. So if you get assigned on this overnight, first off, the stock, the ETF, would have to be in the money. So if you're selling a 597 today, well, then today before 4 p.m., the ETF would have to go in the money. It would have to go above your strike price of 597. Otherwise, you're not going to get assigned, because tomorrow on Friday, even if you do go into the money on this contract, if the SPY goes above 597, you're going to roll it out to Monday anyway to a higher strike price. So the only way you're going to get assigned on this is if it goes in the money and you're not paying attention, or you let it go in the money and then you get assigned. You're not always going to get assigned. But if that was to happen, then you're basically going to collect $59,700, and you're going to have to give this buyer shares. So you will exercise your LEAP option. This is what you will do. You will exercise the LEAP option, which will give you the 100 shares that will go to the buyer. This causes you to lose your LEAP option, though, because you're going to be gaining 59,700 and you're going to be exercising 56,000. So this is only going to give you $3,900, yet it costs you $4,900 for the LEAP. So you lose $1,200 minus the 64 you collected. So you're losing a little over $1,000. You wouldn't want this to happen. The better alternative is to either roll this position, this short position, or what I like to do is buy it back at a loss and then resell a covered call at any time. For example, if you get $64 for this $597 call going out to tomorrow, and the ETF goes up to 598 today, or 599, come tomorrow, this even closer to expiration is going to have a $200 value. This sounds pretty scary. You collected 64, and now it's worth over 200 something dollars. And that's not good, because now you're like $120, $140 in the hole, really close to expiration. But the good news is, and believe me, there is good news here, your short call moves in tandem with your LEAP option. So yes, if you buy back the short call and the ETF has went to $599 at expiration, right at 4 p.m., this option to buy it back would cost you $200. You collected 64, so you're $136 in the hole. However, your LEAP option has also went up in value. It's also moved up in relatively the same amount. Because the delta was 76, the stock went up $2, plus you have to add on gamma. We're not going to bore you with that right now, but it basically means that your long option, your LEAP option, has went up in value by about $140 to $150. Which means even though you bought this short call back at a $130 loss, you can now turn around and just sell your LEAP option for about $120 to $140 gain, which means they cancel each other out and you keep the $64. So do not fear the situation of buying back a short call at a loss, because you can always resell another short call to make that money up. 2 days, you've made that money back, maybe 3. And if you sell the LEAP option, you make it all back and you're in the profit on your short call. They cancel each other out. The loss will be canceled out by the profit. So understand, if you're ever in a situation where your short call, your short position, even if it's $1,000 in the negative, if the SPY was to go to $610 and you're $1,300 in the negative, don't worry. Buy it back at a loss and sell your LEAP option at a $1,300 gain, or just continue to sell more short calls against your LEAP option. And this is what I teach my students. You do not have to worry, because they move in tandem. The one thing that you never want to happen in this situation is you never want to be assigned and then have to exercise your leap because that's where you lose money. Buying the short back at a loss and selling more shorts to make up for it, you make your money back. Buying your short back at a loss and then selling the leap at a gain cancels it out, and you keep the premium that you originally sold the short call for. So those are the two great ways to do it. You don't want to get assigned on the short and exercise the leap because then you lose money. That's not the ideal way to do this. So now that we've figured this out and we understand everything, we go ahead and we select this short call to sell at $5.97. So now we can sell, even if it takes you, let's say you buy two now, and in a week, week and a half, you buy another one, then a week and a half later, the price drops, you buy more. Within a couple of weeks or month, you'll probably have 10, or you can just outright buy 10 if you want. Personally, if you want them all at once, I would buy 4 now, wait for a price drop, no matter how small, add 2 or 3. If it starts to go up a bit, then buy the rest. This way you have some form of dollar cost averaging. But when you have 10 of these, you'll collect about 65 every 48 hours. So you make about $600, and you'll do this 3 times per week, 2 to 3 times per week. So if you figure this out, we're going to sell them every other day, 20 trading days a month. That's 10 times 600. It's about $6,000 a month. So we're going to generate about $6,000 a month going every other day on a very safe delta, which is a lot. Actually, it's more like $6,500 a month. And this is a very good, safe passive income. But if you were to do 0 DTE, you would make considerably more money. So if you have more than 25,000, which you obviously do, if you're running this strategy, probably sell $5.94, $5.95 instead of a 97, because the ETF would have to go up $5 in a day or $3 in a day, which is a lot. I don't think that SPY would hit $5.95 today. I think it's asking a lot of the SPY. So we would go 10 of these per day at 60 a day. You'd make $600 a day, and we'll do 600 times 5. This is about 3,000 times 4. This is $12,000 a month. So you can see on a $40,000 investment, which would be only 20% of your portfolio on a $200,000 account, you're making about $12,000 a month. This doesn't account for the appreciation of the leap option. If the SPY was to go to 620 by April, then it would appreciate. You need about $10 to $15 increase in price to account for theta. On a 560, you would need the stock to be at least, if you buy it right now, at least $608 to $610 to break even 30 days out. And that is the rule. You always sell your leap option about 30 to 45 days before expiration, because that's where theta really kicks in. So if we're doing April 17th, you want to make sure that right around the first or second week of March, you're getting out or planning your exit on this leap option. And in order to break even on the leap option, selling it at that time, the SPY would need to be around 610, which it likely would be 3-4 months down the road. If the SPY was at 620, then you would stand to be about $600 to $800 in profit per contract. So you figure you have at least 4 months before this option, you start looking to sell this option. So you would times this by 4. You can make about $48,000. And then you'd be looking at about $800 times 10, which is about another $8,000 on the option. So if the SPY goes up $20 in 4 months, which it just went up $24 in a day. So going up $28 in 4 or 5 months is very doable, especially in a bullish scenario like we have now with interest rates being cut and the dovish feds that we have going on. This would give you $56,000 profit on just under $50,000 investment. So double your money in about 4.5 months. We divide 56,000, and this would be divided by 4 months because, yeah, you'd be looking to sell right in 4 months. So divide this by 4, and you would have $14,000 a month average income. Now, some might say this doesn't account for losses. Well, I've been doing this a long time, and it really does come down to around $6,000 to $8,000 a month on average throughout the whole year. If you're playing it very, very safe with slight aggressive plays like this, you make on average 10% per month, maybe 12% per month, depending. It really does depend on the movement of the S&P. However, doing 0 DTE options does give you that extra theta, that extra volatility. So even when you're doing a safe trade like this that has a delta of only 21, which is like an 80% chance of success or 82% chance of success, which is really good, you are still going to get such a ridiculous premium because you're doing zero DTE, which is what I highly recommend. So doing zero DTE trading with this, we are going to get about 10%, and 10% of 50,000 is 5,000, maybe a little more. So $6,000, $7,000, $8,000 a month, plus the appreciation of the LEAP option. So getting close to $10,000 a month on a $50,000 investment is nothing. We haven't even touched 100,000 or 200,000. We're only utilizing 50,000 in cash to generate between 5 and 10,000 a month. And if we're slightly aggressive and accounting for appreciation of the LEAP option, can generate safe, consistent income upwards of 14,000 a month. But even if we sold the 596, which is a delta of 15, which is like almost 90% chance of success, we could sell 10 of these daily, collect maybe $40, giving us 400. 400 times 5 is 2,000 times 4. So we would be very safe 8,000 times 4, 32,000, and then another 8,000 on the LEAPS. So we basically just right at the mark doubled our money, and we're going to be doubling our money every 4 to 5 months. So that is a 3x return per year. And that is doing it very safe, because that means the SPY would have to move $4 to $5 every day. Even if this went in the money by $2 to $3, you would just roll out a week and you'd be able to roll up to $5.99 or $600. At some point, the SPY is going to stop going up, and you'll have a few days or a week or two to roll out, make some more premium, and you'd be good to go. And then sure, the LEAP options could go in the negative and you could start losing money, but this doesn't always happen. And when it does happen, even if it's a month, you could still recover based on the short calls, which is what I'm going to show you guys now. Now, remember, I just showed you a strategy to generate $8,000 to $12,000 a month, not including these LEAP options appreciating in value, which ends up being between $10,000 and $14,000 a month on a $50,000 investment. So if you have a $100,000, $200,000 investment, you could really do $30,000 to $35,000 a month. And this doesn't account for any other strategies, just selling calls against these LEAP options. So if we were to have an issue, and let's say SPY dropped back like it did for me, where I went a little bit in the negative, let's just say that SPY drops. It can be very scary if this happens. We'll just clean all this stuff up. There we go. If the SPY starts to drop, consolidate, and then come back up a little bit, and then it starts to drop, immediately sell a covered call at 587. It's already showing signs of resistance here. Now it's going to drop. And as it drops in a day or two, this is completely worthless. Then you'll see some consolidation. If it starts to drop a little more, sell a covered call here. If you start to see a little bit of consolidation again, let this expire, roll it out a little higher. If it starts to come back up, then roll out a little higher and just keep rolling for profits and see if it'll be able to expire. Worthless. If not, roll out again. You're basically following what the charts are showing you. If it was to keep dropping, then you would wait for this sort of thing. It's a, like if we're looking at where the stock would say drop, you'd wait for some type of indicator. So like right here, you would see the stock coming up, you'd see resistance. I would sell right above the previous resistance. Stock comes up, we see the candle, some resistance that's coming down. It's a red candle, previous high right there. We immediately would sell there. Stock comes down. This is now worthless the same day or pretty close to it. Stock comes back up like this, starts resisting, starts to come back down. We go to this high, and we would sell a little bit above, maybe 586. It goes down, and guess what? This is worthless. And even if the stock is trending down, I'll show you guys in a situation where, well, the S&P doesn't hardly ever trend down. But in this situation right here, I would sell a call here. Stock comes down, same day, worthless, or the next day it expires. I'm waiting for the morning to open up. You can see it's 8 a.m., 9 a.m. Resistance starts to pull back, go right up here, and I'd sell a call right here. Comes down, worthless. Stock starts to come back up in the morning right here. Peaks, starts to come down, sell a covered call up there, worthless. See a peak, sell a call, worthless. And you're collecting these all the way down. So let's go back to the math. I just showed you how to perfectly time this every time. And you're not going to get it every time. By the end of the year, most of the time you will. Let's just look at one very simple thing. You are going to generate on the 10 contracts $400 a day times 5 days, 2,000 times 4, $8,000 at the end of the month. Okay? Let's say on those 10 contracts, the stock has now went from, where did it go? It went to 540 from 560. It's a $20 drop, right? So if it's $20 drop, that means we're going to times 0.76 times 20. So you're going to lose about 1,500 minus the gamma, because gamma is going to be a little bit different. You're going to lose probably about 1,100 to 1,200, maybe a little more per contract. So 1,200 times your 10 contracts, you're going to be in the hole. Oops, why did I do that? You're going to be in the whole 12 grand on your LEAP options at this particular time. So on a $50,000 investment, you're in the whole $12,000, but you collected $8,000 that month in covered calls. So you're only in the whole 4. And then if the stock or the ETF consolidates like it is right here, well, this wasn't a whole month. This was only 3 days. So this worst case scenario, you'll see that over the course of another week, it goes back up and you're going to be making more covered call premium. So you figure another $4,000, which is another 2 weeks, and you're at break even. And then when it runs, you're good from there. So these short calls over time, over the course of 4 months, are going to make up for any of these pullbacks. I showed you at a time the pullbacks on the way down, selling the short calls, that is. Let me show you how to do this on the way up. If you guys are looking to grow your portfolio and retire early, like I said earlier, I have students that have implemented this in their portfolio and have already made tens of thousands, if not hundreds of thousands of dollars in 3 to 4 months. They've doubled and even tripled their portfolios over 4 months. If you guys want to learn more of these strategies and more in-depth details on this strategy, you want to join my Discord training and one-on-one coaching, I would love to help you. Like I said, guys, I grew up in a Catholic household, helping people and trying to spread knowledge and spread the wealth with others so you guys can live a better life. And I would love to help you guys out. You can sign up at investwithcorey.com. Links in the information box below. Let me show you guys how you can do this on the uptrend. So you see the stock coming up and it resists. So you'd go up and you would sell a call up here. And this would be midday on the 9th. And we can see that you'd be selling by the end of the day. It would be expired right here. We'd wait for the next morning to open up. We would see the high right here. We'd go ahead and sell up here again. And then you'd see that the stock or the ETF comes up and it expires worthless. The next morning, we see it's opening up at 8, 9 a.m. and it dips. We can see it resists right here at open. So we'd go up here and sell. It tanks. Then by 11, it comes right back up. So we can see it coming up. At this point in time, it's about a 50% gain. Close for 50%, or wait for it to go all the way up here and it's getting ready to close here. And you could hypothetically roll up and out 2 days to maybe Thursday or Friday and could have rolled out to here and it would have expired worthless right here. But what I would have done is waited for this peak right here at 9:30, sold a covered call around 5:51, 5:52 yet again. By the time the stock drives all the way down here by 10 a.m. to 5:40, I would have just bought this back. Anytime your short call is more than 40 to 50% in profit the same morning, within a couple of hours on a 0 DTE, buy it back. So right here at 10 o'clock, I'd be sitting around 50% gain or more. I would have just bought it back. The stock would run. It wouldn't matter because I already bought it back. It closes out and I'd wait till the following morning. So the following morning, we can see right here, it opens up 9 a.m. This wick is pretty volatile, so I'd wait for it to come up. As we see, it hits resistance here at 1 p.m. Right around noonish, 1 p.m., I would go up to about 560, sell, and bam, expired worthless. Next morning, 9 a.m. it opens, it starts to run. We see some consolidation here by 11. I'd go up to 564, 563, whatever a 20 delta is, and sell there. And guess what? By the end of the day, worthless. Rinse and repeat, fam. Right here, 9 a.m., we see this ETF market's opening. The ETF goes up right around here. I would jump up right around 565, sell here. The ETF runs, and by 4 p.m. right here, worthless. Same thing yet again. Monday, open up, 4 a.m. We can see that 9 a.m. the stock market's getting ready to open. Big peak here at 9:30. Jump up to 569, sell. ETF drops, worthless. You see? And when you understand the technicals, and all these technicals I know are very hard to understand, these candlestick patterns. We also have break of structure here, break of structure here, change of character happened over here. There's a lot of things going on at this. Like I said, this confuses you. There is a lot under technical analysis beyond what I'm showing you here. I teach that in my Discord, my one-on-one coaching. Like I said, you guys can sign up at any time. investwithcorey.com. Links in the information box below. This shows you how you can consistently make passive retirement income. And you don't have to do this all day, every day. Another thing you really want to pay attention to on the technical analysis side of things is in the morning, right around 9:30, when you see the stock running up and you see these green candles with all this resistance, you'll see it's being heavily overbought, and yet there's a lot of resistance. When you start seeing the RSI overbought, and the candles have wicks like this at 10, 10:30, you can go up safely to a 20 delta and sell a call. Highly unlikely that it's going to rise that much. Open 561, high 562. In order for this ETF or SPY to jump $1, it's completely overbought. So if we go up here to 564, how is it going to jump $3 more while it's overbought? That's another indicator of when to get into the short position or to sell the short call. Same thing if we were to go over here as the price is consolidating. You see right here, we are looking at 9 a.m. right here. It's got a bearish kind of divergence going on, but you can see clearly right here, the price is resisting at 9:30 a.m. and right here at this peak, it's overbought. Same as here. 10 a.m., big green wick, completely overbought all morning, and it's approaching overbought and resisting. Safe to say you can go up and sell a covered call because this price has only went up $1 and it's approaching overbought. There's no way it peaks all the way up this high without significant news or something else. But you pay attention to the RSI as well because it will dictate what's actually going on. And that's the same thing as when the stock is going to drop. Anytime you're in a downtrend, if you see that it's oversold, it's going to go back up. So you can see the price is coming up, completely overbought. You sell a call. It comes down. Now it's fairly oversold. Buyback at a 50, 70, 80% profit. You see the stock going up right here, overbought. Then it drops after you've sold your covered call, drops all the way down. Now it's oversold. It's probably not going to drop much more yet. It needs some time to cool off all the selling pressure. So this is how you can also decide when you're going to sell your short position. And you see this sell-off right here might be scary, but look how oversold this is. You can tell right here the bullish divergence. It's being oversold and the RSI is starting to come up right here with this resistance in the candle. When you see this, you know a run is happening. It comes up, all this resistance, see the overbought and the resistance on the RSI, bam, you sell your covered call, stock drops for the rest of the day. Keep this in mind. It'll really greatly help you in executing this strategy. You don't have to stare at your computer and be looking at it all day. Between 8:30 in the morning and 9:30 during opening bell, you set up your position, watch the bell, watch the stock go up, and as it resists, you go up and sell your covered call, and you're done for the day. You trade for maybe an hour in the morning and an hour in the evening. By doing 0 DT options, you're probably sitting on your account no more than maybe 2 to 3 hours a day tops, maybe 2 hours a day. Semi-active trader, not a fully active trader, fairly passive income, but you're generating like $8,000 to $10,000 a month or $14,000 a month income, including the growth of the LEAP option. It's a very consistent and safe way to retire early, generate passive income, and a very decent amount of income. If you have a $50,000 account, you could make about $5K a month. A $100,000 account is about $10K a month. $200,000 account is about $15,000 to $20,000 a month. And I just showed you guys exactly how you could do that. I really appreciate you guys being here. If you want to sign up for the Discord and coaching so I can help you guys grow your portfolio, you can do so at any time. InvestWithCorey.com, link in the information box below. And I will see all of you guys on the next video. Thanks so much. Take care of yourselves.